In this video, I'm going to share my July update of my Tfsa Dividend stock portfolio that has outperformed the S&P 500 over the years. I'll share the 22 holdings I have and which stocks I continue to purchase during this bear market. Let's do this. For those that don't know, my wife and I do our finances together. We have 3 accounts through 2 brokerages, Scotia iTrade and Wealthsimple. As you can see from my Wealthica account, the month of July has been great. We are now down 6%, or 11,200 from our highs in April, and that's including our dividends being reinvested, of course. I hope the markets continue to get hammered, and the bad news continues to roll in. And as some of you know, I'm just loving it. This means I can drip or buy more shares at a price I haven't seen for quite some time, prices that according to my calculations is undervalued. So far, the markets have cooperated in August and continue to drop after the second bear market rally of the year. We can expect a few more bear market rallies in the future. Now let's start with our one and only ETF in our TFSA portfolio. VFV, Vanguard's non-hedge S&P 500 Index ETF. We hold VFV because it gives us more US exposure and adds stability to our portfolio. I bought a little over $12 worth at the beginning of the month at an average cost per share of $88.23. I was away for the beginning and the end of July and wasn't watching the markets and actively reinvesting the dividends as they come in, as I usually do. These market conditions really show why trying to time the market is a losing situation. Over the years, reinvesting my dividends has always proven to be better than waiting on the sidelines to buy at the right time. This time around, it wasn't on purpose, but man, sitting on $1,000 cash in my TFSA really hurt. VFV is up 12% at the time of this recording. Right now, it makes up just 0.6% of our portfolio. I'll be growing the position to about 5% in the coming years. I'll look to add substantially in the event of a major pullback. Our second largest holding is still Power Corporation of Canada at 8% of our portfolio, which is a little rich for my liking. This has pulled up about 9% since its lows in the middle of June. It is still down 18% from its September 2021 highs. As a holding company, Power Corporation's NAV is huge compared to the stock price right now. This month, I dripped 5 shares at an average price of $34.63. That added $9.90 to our forward dividend income at a yield of 5.7%. At one point, it was yielding 6% in July. The expected happened. With earnings in early August, profits dropped 47%. I think there will continue to be downward pressure on the stock price. Let's hope it stays in the 9 PE range so we can continue to accumulate at a good valuation like it's 2017. Next up, we have a mid-cap utility in Capital Power Corp at 7.5% of our portfolio. This is definitely a risky position for us as it is a newer independent energy producer, but one of my faves and continues to steamroll that market. It finished the month at an all-time high and it continues to do so into August. They also had a dividend increase of 6% on August 2nd. I know I'm getting ahead of myself now, aren't I? Well, anyway, that increase was a little lower than the 7% dividend growth rate over the past 5 years. They have increased annual dividend growth guidance to 6% through to 2025, from the previous 5%. This bodes well for a mid-cap utility like CPX. We dripped 1 share at a price of $48.89, giving it a yield of 4.8%. Adding $2.32 to our forward annual dividend income. Thank you, CPX. Next up, we have First National Financial at 7.4% of our portfolio. FN has done amazingly well over the past few years and raised their dividend again to keep the streak going. They also gave a 5th consecutive special dividend last year. I do not believe there will be more than a 50-cent special dividend this year. Let's see what they declare in November. Of late, they have had some difficulty with the changing market environment in Canada with the raising interest rates. I have strong conviction that their team will continue to grow and capture more of the Canadian mortgage market and grow the dividend at the 7% they have over the past 10 years. The stock has been on a tear, up 18% since its June lows. It continues on that uptrend in August. Overall, it is still down 29% from the highs of summer 2021. I didn't make any buys in July, as I don't believe this bear market rally will last. I'm hoping to pick up some more shares like I did last month in the low 30s. Next up, at 6.8% of our portfolio, is Bank of Nova Scotia. It is up about 10% from its July 14th low in the month, but is still 30% off its February all-time high. BNS is back to being a high-yielding bank. BNS has been paying consistent dividends for over 100 years, and there's no reason that's going to change. Just the other month, their distribution increased another 3% after an 11.1% increase at the end of 2021. They'll be releasing earnings towards the end of August. We can all expect the earnings will be very different to the comps of 2021. I bought 2.06 shares at a price of $71.95 and dripped one this month at a price of $77.22. This added $12.36 to our forward annual dividend income at a yield of 5.6%. The timing was really unfortunate with the drip. That is one of the major disadvantages of dripping. You never know when it will go through and if the market will bounce up like it did. I hope the price stays depressed in August so I can buy more shares at this price with its PE in the 8s. I'd say that that's great value for this bank that keeps increasing its revenue. Next is TC Energy Corp at 6.4% of our portfolio. I love that they have grown their dividends for 21 years and over the past 20 at 7%. Just recently, they lowered their expected future dividend growth down to 3 to 5%. They had a solid earnings report at the end of the month. They are continuing to dilute shareholders, however, with another $1.8 billion, 28.4 million shares bought deal at a price of $63.50. The timing of this was not the best as TRP hit a new one-year high and a stock price that it hasn't had since 2020. It got within 5% of its highs in July, then pulled back again. The yield isn't where I like to see it, and the growth hasn't been the best. I am interested to see how well it performs in this turbulent market though. If and when the oil cycle comes to an end, I will actively put money back into it. I turned the drip off too late and dripped one share at a price of $67.21 for a yield of 5.4%. That's another $3.60 to our forward annual dividend yield. Oh yeah. Then we have BCE Inc. at 6.5% of our portfolio. This is a core holding of our turf model. They recently raised their dividend 5.1% and have been growing them for 13 straight years. I love telecoms in Canada as they have a huge impenetrable moat and pricing power to perform well in an inflationary period like we're going through. The stock, like many others, is up 5% from its mid-June lows, but it is still down 12% from their April all-time highs. I dripped one share at a price of $64.08, giving it a yield of 5.8%. and adding $3.68 to our forward annual dividend income. I'll be looking to add more to my telecoms as this bear market continues. Next up is ALGONQUIN Power and Utilities Corp, which is our renewable energy play at 5.7% of our portfolio. The price is up 6% from its mid-June lows, but still has 26% upside to reach its all-time high back in 2021. As a utility stock that has been raising dividends for 11 years straight and over the past 5 years at a rate of 7.5%, I'll continue to purchase shares. As a very diversified and well-managed company I believe in, I'll be dollar cost averaging down even more if the price stays as low as it has. I hope their quarterly earnings coming up in mid-August will shed some light on their future growth. This is a dividend growth play after all. In the meantime, I dripped 2 shares at a price of $17.14, adding almost $2 to our forward dividend income at a yield of 5.5%, thanks to AQN's drip discount. Oh yeah. Next is ENBRIDGE at 5.5% of our portfolio. The stock price is up 9% since the June lows. The energy sector is of course really enjoying a rally during these high oil and gas prices. I do not see this lasting for years. The cycle will come to an end, eventually. Even with the pullback, I haven't added any new shares. I do not want to be pulling up my cost average right now. Their earnings report at the end of July was promising. The best part about it was the continued investment of $3.6 billion despite the higher cost of financing them. Al Monaco, the president and CEO, highlighted that ENBRIDGE has a secured growth backlog of $13 billion with capital to be deployed between now and 2026. So I'll be looking for the next pullback when the energy sector is out of favor to add to this position. At 5.1% of our portfolio, we have PEMBINA Pipeline Corp. This is a stock I've been contemplating cutting from the portfolio, as I mentioned in the past few months. They haven't grown dividends for almost 3 years and have a 5.8% 5-year DGR. And then guess what? The rumors turned true. As long as they close the KKR deal, there will be a 0.75 cent monthly dividend increase come November. Their quarterly report at the end of July was really promising too. They have even raised dividend guidance for adjusted EBITDA in 2022. This is the smallest of the 3 pipelines we own. With what is continuing to happen in Europe, I'm fully convinced that gas and oil are here to stay for my lifetime. Like with TRP and ENBRIDGE, in July PPL finished the month up 13% from the June lows. I'll wait until PPL gets closer to my cost average before purchasing any more shares. Next is our last utility, FORTIS, at 4.9% of our portfolio. It has grown dividends for much longer than I've been alive at 48 years. Second most in Canada behind Canadian utilities. Its 20-year dividend growth rate is a healthy 7.7%. It is well diversified and has a stable revenue stream with good, solid continued growth due to investments. Dividend growth is pegged at 6% through 2025. Fortis had a major run-up, hitting an all-time high at the end of May, only to capitulate with the rest of the market in June, and has been choppy ever since. Their quarterly report looked pretty good on the superficial. I haven't had time to read through it in detail. My vacation with my wife is much more enjoyable than reading through pages and pages of financials. I'm sure many of you here would agree. The highlight said, though, that they're on track with their $4 billion capital plan. I hope to drip some discounted shares in September. Before we continue with the second half of our portfolio, let's get another quick word from our sponsor, me again. So hit that like and subscribe button. In exchange, you can see what has delayed our July portfolio reveal this summer. And now back to what we love, stocks, dividend stocks. Next up, we have our first REIT, SmartCentres Real Estate Investment Trust, at 4.8% of our portfolio. This is another staple in our turf portfolio. REITs won't ever fit the rule of 12 I have for myself. For those that don't know what I mean by the rule of 12, here's a short explanation. A stock's dividend rate plus its dividend growth rate should equal 12 or more. That helps the future dividend yield and total return. It also shows the stock is going in the right direction. I want good growth so my dividend income will surpass inflation and give me more and more income as time goes on. Now back to SmartCentres. They are here for stability with $11.7 billion in assets. I like SmartCentres because they're anchored by Walmart, and as I like to say, we all know Walmart isn't going anywhere anytime soon, even with these crazy economic conditions. They have had some trouble during the past 2 years. However, they have been slowly increasing their pipeline of projects from shopping centers to city centers. They have some prime properties in major cities. They had a 10% pullback in June, and so I dived in for a few more shares with one of our dividend paychecks. Since that pullback, it is up about 10%. I was able to grab one share at $27.50 for a yield of 6.7% on July 4th, before the run-up. I'll be looking to add some shares in the event of another pullback. Next is Great-West Lifeco at 4.1% of our portfolio as a solid large cap. I just love how diversified they are for revenue streams, divided between Canada, US, and Europe pretty much equally. They have been steadily growing their dividends for 7 straight years, just like their parent company, Power Corp of Canada. The quarterly report was just released and net earnings were down 6%. The earnings seasons has been going just as everyone thought, with most companies not looking good with the comps. GWO traded below 30 for the first time since February 2021. I really like this play for yield and growth. I think that's why I grabbed one share at $30.22 on July 14th, giving it a massive yield of 6.5%, well above its average yield. Next is MANULIFE Financial Corporation at 3.8% of our portfolio. They are very diversified, with many streams of revenue and have a large presence in Asia. Their share price has struggled since the financial crisis, which doesn't bother me one bit. We're in the accumulation phase of investing after all. MANULIFE will be reporting earnings soon. I expect them to line up with everyone else. Wealth and asset management revenue should be well down from the highs of last year when the market was going crazy. Their stock price is up 8% since the lows of June. Its PE is ridiculous right now. Even with a terrible earnings season, its PE should still be great, with a great dividend yield, showing it is still undervalued. This is the insurance industry after all. It isn't sexy. For those reasons, I'll look to increase my position with some of the cash I have sitting in my TFSA. Next up is TELUS Corporation at 3.8% of our portfolio. TELUS has done exceptionally well at diversifying its revenue, spinning off TELUS International last year. They raised their dividends again and have been for 18 years at 8.7% over the past 10. This stock, like almost the whole market, pulled back huge in June and is up 7% from those lows. It is still off 14% from its April all-time highs. It got close to its 52-week low in June though. I've been wanting to add to my position to get it closer in line with my BCE holding. It had a decent quarterly report, the standout being the 247,000 net customer additions. This bodes well with my thesis on telecoms. With Canada continuing to grow population, telecoms should continue to grow steadily. Then we have a small cap asset management company in FIERA Capital at 3.6% of our portfolio. They have a 5-year dividend growth rate of 6.4%. Their assets under management have dropped recently, really hurting the stock price. They will be reporting earnings in short order. I expect their top and bottom line to be really hurting from the market's bear market. This is the nature of an asset management company. I still believe they are capable of maintaining the dividend. Growth in the future seems slim though, but with that yield, I'll continue to wait. I'm deciding what to do with them in the near future though. The price has been hovering in a 5% range since it hit new lows in June. I don't like to grow my portfolio holdings, just its total return. Right now, FSZ has given a total return of just 19% in 3 years because of its depressed share price. I'll be happy if it gets back to my cost average. Canada National Railway is our only industrial stock at 1.7% of our portfolio. CNR fits the rule of 12 I go by, increasing dividends for 26 years straight with a dividend growth rate of 14.2% over the last 10 years. They are one of 2 big players in the railroad industry in Canada with an impenetrable moat. As a defensive stock, the price is up big time, 17% since its lows in June. It is only 5% down from its all-time highs in March. In hindsight, I should have bought a lot more in June, especially that I had cash on hand. Hopefully I can capitalize next time as I want to double this position. CNR reported earnings at the end of the month, which were really solid, like a train. They had record revenues of over $4.3 billion. I love stocks that continue to grow their revenue year after year, quarter after quarter. Next is my favorite bank, Toronto Dominion at 1.1% of our portfolio. This should be much larger. However, those new to my portfolio, I trimmed it when the stock price was over 100 back in February, and I couldn't see the rationale for it. I'm looking like a hotshot now that the stock is still down 20% from when I sold it. This does go against my rule of not trimming my winners, but I just couldn't justify the price. TD is the best run bank in Canada in my opinion, and has a huge presence in the US. It has a 5-year DGR of 7.9%, and I expect another raise come the end of the year. I need to add to this big time to get my position back to where it should be in my portfolio. It'll be reporting earnings in August, like the rest of the other banks, and should follow the trend of bad year-over-year comps, which may spook the market. It'll be interesting to see how low she goes. In any case, I bought 1.33 shares in July at an average cost of $79.08. That provided $4.74 to our forward annual income at a yield of 4.5%. With so much cash in our account still, I'll look to keep adding in August. Next is our last bank in Canadian Imperial Bank of Commerce at 0.9% of our portfolio. This is another bank that I trimmed during their all-time highs. Some got excited by the 2-for-1 split. This is the smallest of the original Big 5 banks and is heavy into real estate. This is another reason I decided to trim my holding here, and like TD, my wife and I look like hotshots. It was pure luck. Everyone knows that timing the market is impossible. I feel the Canadian real estate market will be depressed for some time. The rising interest rates should lead to less mortgage originations and less revenue. They are still a solid dividend grower at 5.4% over the last 5 years. CM up 9% at the end of July compared to mid-July. Those prices in mid-July haven't been seen since March of 2021. CM is still down 22% from its all-time highs in February. I plan on adding to my position again as long as the price is right, no matter how bad the earnings report looks. This will stay as the weakest or the lowest weighted bank in our portfolio. And lastly, our smallest at 0.5% of our portfolio is GOEASY Ltd. They are in the credit services industry. It is a high-growth, small-cap stock in the financial sector. After the major pullback this year and continued growth, I looked into their business model deeper and was convinced they have a large door of opportunity given the rising interest rate situation, high inflation, and a big buffer with the leverage they use. GSY will be reporting earnings in August, like other stocks in our portfolio. I am expecting good growth based on the industry they're in. When Canadians are in a pinch, this is where they will come. GSY is still down 49% from its all-time high of $218.35. They were down again in mid-July, in the mid-90s, but have since recovered 19%. I should have taken the opportunity to grab more shares like I did in June. I'm trying to build out this position as a small-cap growth prospect. CANOE EIT Income Fund is making up 1.8% of our portfolio. I like its holdings, diversification, and fund manager. I've just been enjoying the distributions and reinvesting them elsewhere for a long time now. At some point, before I die, I will divest this income fund. It has provided a very healthy 10% CAGR over the years, which beats the market. But I think there are better opportunities out there. And still, our largest holding is RIOCAN Real Estate Investment Trust at 9.2% of our portfolio, down a little from last update. I added a lot during the 2020 crash to bring down my cost average, not expecting the distribution to be cut in early 2021. They have $14 billion in assets and a ton of properties under development in the Toronto area that will add to their AFFO. They are reporting earnings in just a few days in August. Like the rest of the market, this stock tumbled in mid-July, but recovered 6% by month's end. It is still 21% down from its March high, giving it about 30% upside. I dripped 2 shares and bought one at an average cost of $20.06, adding $3.06 to our forward annual dividend income at a yield of 5.1%. So there you have it, all 22 of our holdings and what purchases we made this month. We deployed a total of $880.12, adding $47.09 to our forward annual dividend income this month at an average yield of 5.4%. No fresh cash was added, of course, as I maxed out our contributions in January. If you have followed our dividend income report, you'll notice we have been building a cash position. This has not been intentional. We have been on holidays, and it's my fault I haven't kept up with reinvesting our dividends. I hope to catch up after this bear market rally. Thank you so much for watching and helping the channel out by smashing that like and subscribe button. I hope you found it interesting to see what we are doing with our TFSA to grow dividends. Until next time, I'm Mr. Financial.